Hey everyone, welcome to JD's Guidance. Friends, in this video, we are going to see the concept of profit maximization versus wealth maximization. Now, when we say what is the objective of financial management, generally there are two approaches. One is the traditional approach, the other is the modern approach. Under traditional approach, profit maximization is the objective of a business enterprise, whereas under the modern approach, it is the wealth maximization which is the objective for a business enterprise. Now let's understand what is profit maximization, what is wealth maximization, and how is one superior over another. Let's understand first profit maximization. As the name itself indicates, profit maximization here means the organization should direct all its efforts to maximize the profit. That means whenever a business organization takes decision or it is maybe with respect to financing, investment or dividend, or to put it more simply, if an organization is choosing among projects, choosing amongst the alternative assets, all the decisions should be guided by only one test, that is profit. The one which gives more profit should be accepted, whereas the one which does not give much profit should be discarded. Now, what is wealth maximization? Wealth maximization, on the contrary, is not about maximizing the profit, but maximizing the shareholders' value or shareholders' wealth. What does this mean? Here, when we say profit maximization, that does not necessarily mean that the shareholders who have invested their money, their value is maximized. What is value maximization? Value maximization means the market price of the shares should go high. 100 rupees invested today at a market price of 100, in time it should be appreciated. It may go to 120, 150, 180, then we can say the shareholders value or wealth is created. So profit is a narrow concept, whereas wealth is a broader concept. Or in other words, we can say profit is more or less a short-term objective for a business organization, but in the long period we want growth, expansion, which is possible only when the shareholders wealth or the shareholders market price of the share gets appreciated. As the market price of the share appreciates, the shareholder wealth is maximized. Now let's understand the drawbacks of profit maximization. Now there are actually, before knowing the drawback, let's understand what is the usefulness if I keep profit as a business objective. Now, if profit is a business objective, no doubt we will direct all our efforts to choose that asset, that project which gives us maximum profit. That means the enterprise resources will be directed to the most profitable use, that is for sure, because our idea in mind is to maximize profit. So we will eliminate wastages. We will not be motivated or inclined to take up any project which gives us less profit. So here our efficient use of resources is assured under profit maximization, but it suffers from certain limitations. I will just mention three very major limitations of profit. The first thing is ambiguity. Profit as such is an ambiguous concept, or it is a vague concept. To put it more simply, what is profit is not very clear. When I say profit is to be maximized, do we mean the profit after tax, or are we referring to the profit before tax, or do we mean return on assets, or do we mean return on investment? So there are various ways by which I can measure the term called profit. So there is no clear cut or precise meaning of what is profit, and therefore it becomes difficult to operationalize this objective. So ambiguity is one limitation. The second limitation, which is the most important limitation, is that profit maximization objective do not take into account the time value of money. That means, in other words, the timing of the profits. I give you one example to make it clear. For suppose we have a project 1 and we have a project 2. And in year 1, project 1 gives me 50, project 2 does not give me any return. Year 2, project gives me 100, here also it gives me 100. In year 3, project gives me 100, and suppose it gives me say 200, or I will keep it as 250, or I just keep it as 150. So you can see that when I keep it as 150, the total profit earned from this project is 250, whereas the project earns one earns 250. So when I say the profits, there is no difference between project 1 and project 2. So my profit is the same for both the projects, so I'm indifferent and I may choose any of this. But one thing to be noticed is that we are not considering the timings. You see, project 1 gives you the profit right in the year 1, but project 2 does not give anything in year 1. Now, what is the disadvantage then? Disadvantage is that generally we prefer to receive money as early as possible. Investors, when they have put money in the business or in the company, they want their return should come as early as possible. So this is called time preference of money or time value of money. So I will give more value to this 50 rupees which I receive in year 1 than any other 50 rupees that I receive in year 2 or year 3. This is ignored by the profit maximization concept, because ultimately we are guided by the total profits of period 1 and total profits of period 2. This is the second limitation. Let's talk about the third limitation. The third limitation says that we are not considering the risk factor, or the certainty of earning the returns is not considered under profit maximization. For example, I may have project 1, I may have project 2, and I may have a say for example a normal situation, a recession, or I will put it in a different order. Suppose I have a recessionary period, I have a normal period, and I have boom. This is the period of prosperity and this is recession. So suppose this project gives me 9 rupees, 10 rupees and 11 rupees. This project does not give anything in a recession, but in period 2 it gives me 10, or we can say in a normal situation it gives me 10 and this gives me 20. So total comes to 30 here also, the total comes to 30 here also. So you can see that if I talk about the profits, ultimately both the projects give me same profit, but the certainty with which I can earn profit is less in case of period 2 but more in case of period 1. So this project is more risky, because if the economic recession takes place, I will not earn any profit, but even if the recession is there, I will still earn some profit. But this analysis is not possible if profit is our objective, because neither it takes into account the risk or certainty of earnings, or in other words quality of earnings, but also it does not take into account the time preference or time value of money. Otherwise, there are other problems also. When I say profit is to be maximized, there are chances that workers may be exploited, the employees may be exploited with the rush to earn more and more profit. Workers compensation or salaries may be cut down so as to earn more profit. So an enterprise may indulge into some unfair practices if profit is to be maximized. Now let's go to shareholders wealth maximization. Shareholder wealth maximization, as I already told, is a concept where we want to maximize the market value of the shares and not profit. We are not concerned about profit. Now, how it is a superior concept? It is superior because it keeps in account both the time value of money as well as the risk aspect. So I said there are three limitations of profit maximization. Number one is that this this suffers from the problem of ambiguity. This suffers from the problem that it does not take into account the time value of money, and it does not take into account the last thing, that is the risk preference, or you can say the certainty of earning or quality of earning. Now, and otherwise there are other problems also, exploitation and this and that. Now, the shareholders wealth maximization concept takes care of this. How? Ambiguity is taken care of because here profit is not our objective. Here our objective is to maximize the wealth. When I say maximize the wealth, we take into account the cash flows. We would see how much money invested by the shareholders and the benefit that is been derived. So how much is the benefit in relation to the cost of money that is been put in? So we are measuring it in terms of the cash flows. We are talking about the future cash flows that will come to the business, which is a very precise concept. There is no ambiguity when I say cash flow. Money that is coming to the business, not profit. So ambiguity is taken care of by this wealth maximization concept. Second is the time value of money. When I know what is the cash flows which is coming, then what I will do is that I will try to see which are the cash flows which come to me later and which are the cash flows which come to me early. Generally, the cash which comes to me at a future date, I will discount it. I will try to discount it and find out its value or worth today. So how do I discount? There are some techniques. So generally what we do is that when I have to wait for a longer time period to get the money back or get the cash or get the benefits or get the receipts, I will discount it at a higher rate, because investors are taking more risk in this case and they have to wait a longer period of time, and therefore there is an opportunity cost. For example, 50 rupees which I did not earn anything, had I been earning this 50 rupees, I would have put in a bank deposit or any other investment, it would have given me some returns. So when I'm talking about cash flows, I'm discounting the cash flows. I'm trying to find out its worth at a particular point of time. The money which will come to me in future, I'm trying to discount it and find out its worth at a point of time. Therefore, the time value of money is considered under shareholders' wealth maximization. Second thing is the risk preference. Obviously, when we are talking about the periods, recession, normal, and boom period, and under shareholders wealth maximization, we are also taking into account the risk factor. For example, I am discounting the cash flows at 15%, 0.15. Now, if I see that I have to wait for a long period of time, I will discount it at a higher rate, 0.20. So that means the riskiness of the inflows or receipts or benefits is compensated by discounting it at a higher rate. And therefore, it helps us to know what is the worth of that money which is invested to the shareholders. So shareholders wealth maximization is actually the ultimate measure or ultimate objective of a business organization. So I hope this is clear. So in nutshell, profit maximization is a narrow concept, it's a short run concept, it suffers from the limitations of ambiguity, it does not take into account the timings of the benefits, and also it is not considering the certainty or the quality of earnings. Whereas on the other hand, shareholders wealth maximization takes care of this ambiguity, because it is measuring the benefits in terms of cash flows, which is very precise. It also takes into account the time value or time preference, because it is trying to discount the flows, discount the receipts at a particular point of time and find its worth at point zero. Also, it takes into account the risk preference, because longer the time period, I will have to be compensated by discounting at a higher rate. So that's all about the difference between the profit making versus wealth making as an objective of financial management. Hope you have understood. If you have any queries, do post in the comment. Thank you for watching. Bye bye.